Hello, everyone, and welcome to the Virginia Society of Enrolled Agents webinar today. Tax law changes related to the coronavirus pandemic. This is a 2 CE webinar. We are providing IRS CE for this event, but as always, if you have been a part of webinars that provide IRS CE, you probably know that you must be present for at least 100 minutes. So once again, since this is 2 CEs, that's 2 times 50. So you must be present for at least 100 minutes today. You also need to be actively engaged. This particular platform will be able to track your engagement. So don't think you're going to click on another tab, but go be in Facebook or something like that. You need to be actively engaged with us. And you also need to answer at least 8 polling questions. Now we will put up somewhere between 8 and 10 polling questions. I haven't decided yet how many. We'll see how it goes. There are 10 polling questions in my queue, but we'll put up between 8 and 10. So make sure that you answer each polling question as those come up. Do not worry if you do not know the right answer. Some of the questions, by the way, do not have a right or wrong answer. Some of them absolutely do have a right or wrong answer. But even if you get it wrong, you don't get graded whether you got it right or wrong. You simply get graded on the fact that you are participating. And this is one of the IRS guidelines that we have to follow. Someone else is asking about handouts. Those are available for you on the Handouts tab. And so if you will click on the Handouts tab, you will be able to download the handouts there. And someone else is asking, will there be a recorded version available? Yes, we are recording today, and the recording will be sent out probably this evening to everyone who attended today, and you will be able to see those for sure. Someone else is asking, does today's webinar qualify for CEUs for CPAs? And the short answer is no. So those of you that have taken classes with me before are likely aware that I do a lot of webinars that do offer CEUs or NASBA CPE, as well as CLE, sometimes for attorneys or CLEC. But today, this one is IRS CE only. This particular event is sponsored by the Virginia Society of Enrolled Agents. They are approved to offer NASBA credit for their live events, but not group internet-based, which is what webinars are. And so we cannot offer CEUs today. Having said that, I think you'll still find value for sure in what you're seeing today. And David is here from London, so we do have someone from across the pond. So good to see you here as well. So that's our housekeeping for today. Once again, make sure you are here for at least 100 minutes. And
Knox, would you clarify that what we're going to cover today and what compared to what passed last night in the Senate? Because we're getting a couple of questions that are related to what happened last night versus what we're going to cover today.
Yeah, so we will be doing that along the way. I can tell you that we'll go over what we're going to cover in a minute. But before we do that, and by the way, John, you can PM me real quick if you've got something real quick, but I can't do it at the moment. So if anybody has any other questions or problems, you want to throw those into the public chat. But if you have questions along the way that relate to what we are covering, you want to put those into the Q&A. We do have 3 of us here today who will be monitoring that. But I will tell you that as I am teaching, I typically am not looking at the Q&A when I have this large of a crowd. I just can't follow it. So be aware of that. Craig, you're trying to invite someone to log into the webinar, but cannot get her in. If you will, Craig, send them to the landing page. They cannot use your link. It's only one person can use your link, but if you send them to the landing page for them to register, then they will be able to come right in. All right. With that, I'm going to go ahead and turn it over to the president of the Virginia Society of Enrolled Agents and let her welcome us.
Good afternoon, everyone. Thank you for joining us for the special webinar on tax law changes related to the COVID-19. My name is Ty Gaines, Enrolled Agent, and I'm the current president of the Virginia Society of Enrolled Agents. For those of you who don't know, enrolled agents are federally authorized tax practitioners empowered by the U.S. Department of Treasury to represent taxpayers before all levels of the IRS, including audits, collections, and appeals. Believe it or not, enrolled agents have a history of helping America in a time of crisis. The EA designation dates back to right after the Civil War. Questionable claims were being presented for Civil War losses, so Congress started regulating who could represent citizens in their dealings with the U.S. Treasury. And there you go, here we are, EAs. We have very active members in the Virginia Society of Enrolled Agents, and we meet with federal and local legislators regarding tax law changes on an ongoing basis. We also have educational seminars that include representatives from nearby states, the departments of taxation for Virginia, Maryland, DC, North Carolina. We also maintain constant contact with our IRS stakeholder liaisons. Our organization is made up of knowledgeable and friendly tax professionals who support each other and the community. This webinar is our example of that. I am pleased to introduce two more Virginia Society of Enrolled Agents board members, Knox Wimberly, EA of Knox Taxes in Bradford, Virginia, and Vaughn Long, EA of Tax Solutions Alliance in Chesterfield, Virginia. I want to thank both of them for their time and effort during this challenging period to spend their last few weeks putting this together so that we can have some information for you. I will turn it over to them now. Thanks, guys. Take it away.
Thanks, guys. So tell everybody, here's what we're going to be covering today. The goal, there's been a number of things that have come through, and Knox is going to go into this in more detail over the last couple of weeks. And just a quick note, we will not be covering in detail what passed the Senate last night. I know there's some questions come out. If we have a few minutes at the end, we can share some high-level details, but remember, it's passed the Senate, has not passed the House, so it may not even be a final bill at this point. So just wanted to throw that out to you. Just an intro for myself. My name is Vaughn Long. I've been an enrolled agent since 2010. I am a specialist in the IRS collections side of things. I was trained by a former revenue officer who worked in the IRS for 28 years and then in private practice for 20 more years before he went into what he calls semi-retirement. So we work every case you can imagine, high dollar, payroll tax, trust fund, all the way down. So I'll be chatting a bit about that later, some of the directions that came out from the IRS last night through the document they published. I also own a second firm that does small business tax returns and accounting. So I know this side, it's most of you out there. So we'll be coming from that perspective today. And some of you can tell in the video, depending on how far the camera goes back, I am in a t-shirt and a tie. I am doing a series of videos on YouTube called Tax Tie Guy, all one word. It is geared more to your clients, not tax professionals, trying to explain some of these as well and the situations we're going through. So look out for that, and I'm going to kick it over to Knox.
All right, and good news for the CPAs that are on with us today. John Sheely of Tax Practice Pro is on the webinar today and graciously volunteered to offer NASBA credit for this. He knows that if I'm involved, there's going to be quality. And so he said he would offer NASBA CPE today. So you will get 2 NASBA CPE credits if you are CPAs on today as well. So big thank you to Tax Practice Pro and John Sheely. Those of you that don't know John, he provides fantastic education as well. So we're appreciative to him of doing that today. For those that don't know me, I am Knox Wimberly. Obviously, I'm an enrolled agent. My areas of expertise are the taxation of clergy, cryptocurrency, cannabis, foreign earned income, estates, really trust, anything on the 1041 fiduciary return in particular, as well as S Corps. And then I do a little bit of tax resolution. I am a fellow of the National Tax Practice Institute. And in addition to my personal practice, as someone asked earlier, I did most recently serve as the Chief Tax Officer for Happy Tax, for Opportunity Tax, for CryptoTaxPrep.com, for CryptoTaxAcademy.com, and for CannabisTaxAcademy.com. In terms of what we're going to do today, we're going to take a look at several different administrative procedures that the IRS has released over the last couple of weeks, as well as a significant law. And then we're going to talk a little bit about something that's not yet a law, but we're not going to spend much time on that because it could still change. It hasn't even been passed by both houses yet. It's been passed by the Senate last night, but not by the House yet, which means it could still change. But we're going to talk about Notice 2020-15. If you don't know what that is yet, don't worry, you will soon. We're going to talk about Notice 2020-17. But we're going to spend more time on Notice 2020-18 because that is more relevant than 17. You'll understand what I mean by that as we move forward. Then Vaughn is going to talk about something that actually came out yesterday and he alluded to, and that's 2020-59. He'll tell you more about what's involved in that. And then I will lead us through an analysis of the Families First Coronavirus Response Act, and in particular, the parts that we care about as tax practitioners are going to be the Emergency Paid Sick Leave Act, the Emergency Family and Medical Leave Expansion Act, and then how we pay for those things. So those are all a part of the Families First Coronavirus Response Act. We'll be looking at that. And then we're going to look briefly at Section 139 of the Internal Revenue Code. You say, why on earth would we do that? You'll understand as we move through. And then we're just going to really just touch, but not much at all, on the CARES Act because it is not yet law. So we're going to begin with Notice 2020-15. But before we do that, we're going to go ahead and launch our first polling question of the day. So get ready. This one is not a hard polling question at all. The question, what credentials do you hold? Are you a CPA, a CFP, an EA, an attorney, none of the above, but an AFSP participant or none of the above? You can select as many as apply here, but what credentials do you hold? This will just give us an idea of who is present with us today. And I will give you just a moment. We're going to give you about 40 seconds longer to answer that question. This will be the easiest polling question of the day, I hope. Hopefully this one's not hard for you at all. All right. A couple of people are asking me, how can they get someone else on the webinar? At this point, they can reach out to the Virginia Society and give them a call, and the administrator can help you. Otherwise, they're going to have to do the recording. I unfortunately cannot help them myself while I'm teaching. Yes, if you got invited, simply click on the link and they can register and come on in. Fantastic. All right, we'll give 10 more seconds on the poll. Closing in 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Looks like about 61% of us today are EAs, about 21% of us are CPAs. And that makes some sense since this particular webinar is sponsored by the Virginia Society of Enrolled Agents. Often I find that I have 2/3 to 3/4 CPAs on my webinars, but it makes sense that we would have more in this one. So we're going to go ahead and talk through this Notice 2020-15 and find out what's involved. Well, let's look at some background first. The Internal Revenue Code, Section 223, deals with high deductible health plans and health savings accounts. So we need to sort of understand that background. And part of what is true for a health savings account is that in order for the contributions to be deductible, it has to be paired with a high deductible health plan. And only preventative care items are allowed without a deductible. In other words, the insurance cannot pay for anything until the complete deductible has been met, and that includes, by the way, prescriptions. The insurance cannot pay for anything other than preventative care items until that deductible has been met to qualify the HSA contributions to be deductible. So this particular notice addresses that issue and allows for all medical care services received and the items purchased associated with testing and treatment of the coronavirus or COVID-19 to be disregarded in determining the status. In other words, if they provide these items free of charge, that is not going to be something that disqualifies the plan as a high deductible health plan, which would then in turn disqualify the contributions to the health savings account. So this was pretty important to come out early on. So that's Notice 2020-15, very high level. That's all I'm going to say about that. If anyone has specific questions, you can ask, but I did want you to be aware of it. Now, Notice 2020-17 was very short-lived, but it was in response to President Trump, who issued an emergency declaration under the Stafford Act. We're going to talk more about that as we move through the webinar into a later place, why that is significant that this declaration was issued under the Staff Act. But it instructed the Secretary of the Treasury to provide relief from tax deadlines. That's a direct quote. And it is pursuant to 7508A, subsection A. So this is a section in the Internal Revenue Code. 7508A, and it says that it is a federally declared disaster as defined by Section 165, which is going back to the Stafford Act. Now, this all becomes very important because this opens up some specific opportunities for relief, some of which we're going to talk about in this notice and the next, and some of which we're going to talk about towards the end of the webinar. It broadly defined who is impacted by this emergency, and this is how broadly it defined it. It said it's not someone who's sick, it's not someone who can't go to work, it is anyone who has a federal income tax payment due by April 15, 2020. Or on April 15, 2020 is what I should have said, not by, because it did not include any other dates. So anyone with a federal income tax payment due on April 15, 2020 is impacted according to this notice. So that basically means all U.S. taxpayers who have a payment date of April 15, 2020. Now, who are taxpayers? Who are persons who have a date? Well, obviously, these are individual income tax filers, but it also includes many C corporations, particularly calendar year C corps, and it could include some others as well. Now, this is going to be fixed a little bit in 2018, so I'm not going to spend a ton of time there, but just be aware that it very broadly defined who is impacted by this emergency. And what it did was it postponed the payments to July 15 of 2020. Now, notice it did not extend the filing deadline. Don't freak out on me and say, but Knox, I heard the filing deadline is extended. We're only right now talking about 2020-17. And it actually provided limits. It said that the payments up to $1 million or up to $10 million for consolidated groups or C corps were extended or actually postponed until July 15. Now, notice 2018 actually went a step further, and it supersedes notice 2020-17. Again, it expands on the relief, and in this case, it defines the affected taxpayer, much like 2020-17, as any person with a federal income tax payment or, so this is a fix, or a federal income tax return due on April 15, 2020. So the first one only dealt with payments, right? So we're expanding this definition once again to now include anyone who has an income tax return due on April 15, 2020. Now notice this said an income tax return. It did not say an information return. It didn't say a sales tax return. It simply said a federal income tax return. Again, the person is defined. If you want to go look that up, that's section 7701. Of the Internal Revenue Code, and that is where a person is defined in the IRC or the Internal Revenue Code. But to simplify it for you, it's an individual, a trust, an estate, a partnership, an association, a company, or a corporation. So don't be confused that a person only relates to an individual. When we're talking about the Internal Revenue Code, a person can include an individual, a trust, an estate, a partnership, an association, a company, or a corporation. And this notice, that's 2020-18, put the due date for both filing and payments to be July 15 of 2020 for those returns and payments that were due on April 15 of 2020. We're going to talk more about that in a minute. So notice 2020-17 extended the payments. This one changes the due date for filing and for payments. And we're going to talk about the significance some more in just a moment. So this removed the limitations of 2020-17, meaning we no longer had that $1 million or $10 million threshold that we were limited to. There are no limits now. So we've completely removed those limitations, and it includes estimated income tax payments, in this case, that were due on April 15 of 2020. So for those of you that are familiar with this, which should be most of us, quarter one estimated payments are typically due on April 15 for individual filers or for calendar year, right? So those quarter one estimated tax payments were due on April 15. Now they're going to be due for 2020 on July 15 of 2020. But be aware, information returns are not included. We're going to talk more about that in just a minute. But I will tell you real quickly, one of the questions I see most frequently is, well, Knox, what about the FinCEN 114? For those of you that don't know what the FinCEN 114 is, that's the FBAR return. It's an information return. It's not a tax return. In fact, it doesn't actually get filed with the IRS. It gets filed with FinCEN at the BSA related to the Bank Secrecy Act. It's another Department of Treasury. However, it is the IRS that is responsible for enforcing FinCEN 114 or the FBAR. The FBAR is not actually impacted by this. However, it's irrelevant because the FinCEN 114 is automatically extended through October 15. So even though it's not impacted by Notice 2020-18, we already had an extension until October 15 of 2020 already. So it's a non-issue. So it's interesting to me that we've seen so many questions about the FBAR or the FinCEN 114. It's a non-issue. Don't worry about it. All right. Interest penalties and additions to tax with respect to such postponed federal income tax filings and payments begin to accrue on July 16th. So this means that even though we're not filing until July 15, none of those penalties, none of those interest or anything like that are going to begin to accrue until after that July 15 deadline. It literally moved the deadline this year. So this is not just an extension per se. This is a move of the deadline. This becomes significant when we start talking about retirement accounts, and we'll talk more about that in just a minute. You are not required to file a form to get the extension. So this means we don't have to file the 4868. We don't have to file the 7004 for the included returns. We're going to talk about some returns that are not included in a minute because there are some gotchas here that I want you to be aware of. So let's talk about some things to note that I just want to make sure you're aware of. First of all, Q2 estimated tax payments are not impacted by this. So that means that they're now due before Q1. Well, what do you mean by that, Knox? Well, Q2 is due on June 15th. Hopefully you know that. So Q2 is still due on June 15th because it's not impacted by this. But now Q1 is due July 15th. And somebody out there is going to say, well, Knox, that doesn't make any sense. The government does not always make sense. Did you not know that yet? But nonetheless, this is where we are. Now, might we see a correction to that? Might we see a notice at some point in the future that fixes that? Maybe. Might we see a bill that comes out and gets passed that fixes that? Maybe. But today, I'm talking about what is current. I'm not talking about bills that have not yet passed both houses and become law. I'm talking about what is current. So be aware of that. The other thing to be aware of is that with respect to returns that were due on March 16th, those normally March 15th, but that was a Sunday this year, so it was March 16. Those are completely not impacted by this whatsoever. So I hope you filed the 1065s. I hope you filed the 1066s. I hope you filed the 1120Ss. And frankly, I hope you filed the 3520As. So some of those returns needed to be filed on March 15, March 16 this year. Hope you did that. If you did not, I unofficially have heard that the IRS will probably be giving some extra leniency for reasonable cause as we look for penalty abatement on this, but there is nothing official that says that to my knowledge at this point. So be aware of that. So hopefully you filed those. If you didn't, you want to go ahead and get those in because most of those penalties are monthly and they can add up in a hurry, and probably you know about all of that. So fiscal year taxpayers with returns due April 15 are included, by the way. So there are some fiscal year taxpayers with returns that are due April 15. That's going to be included because they're due April 15, and that's specifically what the notice addresses. But returns that were due May 15 are not included, as we said. By the way, payroll and excise taxes are not included. I've seen some real confusion online about that. Some people saying, oh, well, this is extending. No, payroll and excise taxes are not included. And this is a biggie. Notice I put pay attention here. Gift tax returns. So those 709s that everyone is used to sort of doing with the 1040s, these are not extended. Those are considered, well, anyway, they're just not extended. And so you need to be aware that there could be a potential gotcha here. If you have a gift tax return that you need to file and you're not ready to file that return before April 15, you need to file an extension. There are two ways to do that. You can go ahead and file the 4868. which will automatically extend the gift tax return. And that is my recommendation. In those cases, if you think there's a potential gift tax return issue or generation skipping tax issue or state, then you need to go ahead and file the extension on those. There's also a specific form for gift tax returns that you can use just to extend the gift tax return. I don't actually recommend that. I recommend going ahead and doing the 4868 because that will automatically extend it. And that, of course, is going to give you until October 15th. So that's what I would recommend doing. But pay attention. You don't want to get caught on late 709s. The other thing to be aware of is that, at least by my read right now, I did not see a change to the June 15 deadline, just like we don't have a change to the Q2 estimated payments. So for our taxpayers who are outside of the U.S. and they automatically have that June 15 deadline, I think they probably still have that June 15 deadline. Now, was that intended? Maybe not. But unless we see something that comes out that says that they do not, I think we have to assume that their deadline is still June 15th. So don't get caught by that. For your taxpayers that are outside of the country and normally have that June 15 deadline, I think that is still the case at this point. So be aware of that. Another thing to be aware of is that you can still file the extension. So the 4868, the 7004, those can still be filed until July 15. But, and again, this is under current. A new law may change things, but it's not law yet. That will extend to October 15 of 2020. We're going to go ahead and issue our second polling question of the day. And get ready for that one because it is coming. So once again, this will be your second polling question of the day. This one is about Notice 2020-15 and ask, what does it have to do with? And you will need to select the best answer here. I will give you just a moment to do so. All right. Give you a couple more moments to answer that one. Interesting answers that I'm seeing come in here. All right, so Notice 2020-15 has to do with, first option, Internal Revenue Code, Section 223. Second option, COVID-19. Third option, high deductible health plans. Fourth option, health savings accounts. Fifth option, all of the above. Or sixth option, none of the above. Remember, you don't have to get it right to get credit, but try to get it right. We'll give about another 20 seconds. So Kellyanne is asking, what about 990s? Have those due dates changed? And the answer is no, in general. However, there are also 990Ts, and the short answer is those haven't changed. So be aware of that. Those have not changed. And let's see. Someone else has a couple of questions here. So the estate income tax return is the fiduciary right on the 1041. There also is a 706, a Form 706, which is actually the estate return. So be aware of. But yes, I was talking about the 1041. The fiduciary. Yep. All right. Perfect. We had a couple other questions coming in here as well. Looks like most people are answering these. All right. Good job. All right. So we're going to go ahead and close this poll in 5, 4, 3, 2, 1. Interesting results. So the correct answer was all of the above, and only 46% of you got that correct, which means I didn't do a great job of teaching that section. So shame on Knox. That is a reflection on me. The good news is only 2% of you said the one that is absolutely wrong, which would be none of the above. But it does involve IRC Section 223. It does involve COVID-19. It does involve high deductible health plans, and it involves health savings accounts. It involves all of the above. That's what Notice 2020-15 is all about. All right, fantastic. We're going to go ahead and get back to our material. We have a lot to cover today. And one of the questions that I have seen frequently is, what about the payment, Knox? I already filed this return, and the payment is scheduled to come out on April the 15th. What happens here? So the payment is not going to automatically be rescheduled. If you put a payment in to come out on October 15, then the payment is going to come out, on April 15, then the payment is going to come out on April 15. However, if you want to cancel and reschedule that payment, there are ways to do that. I'm not going to go through this and read all of this, but it's in your material to put it there because it's different depending on what type of way, and it's not that difficult. I also want to highlight that you need to be careful about states. Remember that a federal IRS notice does not automatically change things for most states. Now, some states are tied to federal, some states are not. So be careful about states. I've given you 3 different places that you can find some information about that. AICPA has a really up-to-date and good list. CCH IntelliConnect also has a nice PDF on this. If you are a member of the Virginia Society of Enrolled Agents or the National Association of Enrolled Agents, then you have access to that for free. Also, Drake Software has an update list. And I didn't make any sense in that sentence. I apologize. I should have fixed that, but it's an up-to-date list, not an update to date. That doesn't even make sense, but it's an up-to-date list. And that is available outside of the paywall as well. And so each of those are good sources, but be careful about states and make sure that you check what is happening there. So I mentioned that the due date actually changed. And because the due date actually changed, this means that IRA and HSA and Archer MSA contributions can be made up until July 15. So once again, some of those retirement accounts, plus your health savings accounts and your Archer medical savings account, all of those contributions can be made up until July 15. So that's pretty major. Now, interestingly enough, this is what the IRS has said, but not all of the companies out there that handle these sorts of things have their computers programmed to be able to handle that. So just be aware of that. They may or may not get it done. But from an IRS perspective, you can make those up until July 15. The other thing that I want you to be aware of is this does not extend the RSED. So if you're dealing with a 2016 return, this does not extend the refund statute in any way, shape, or form. I've seen some people ask that question. It does not extend that in any way, shape, or form. So don't want people to be confused about that. And with that, Vaughn, I'm going to go ahead and turn it over to you to talk some about 2020-59.
I tell you, Knox, before I jump into that, can you go 2 complete slides back? Notice 2020-18 things to note. For that one, there we go. Pop back. And it had all that detail. I wanted to make sure you did a lot of great work on the slide. I know we're running tight on time. So I want to point out to the audience, make sure you identify the slide, because Knox has identified step-by-step instructions for direct pay, EFTPS, you name it, credit cards. Make sure you come back to this if you're explaining this to a taxpayer or your client, or you're doing it yourself. I just wanted to throw that shout out there. Thanks, Knox. All right, we're going to jump into, as is listed there, IRS IR 2020-59. This was published yesterday. So we feverishly read through this last night, and we're going to share the outline of the details moving forward. And of course, my phone call is right at the middle of this. So this applicable date span for this document for IRS collections is focused on April 1, 2020. So that's next Wednesday, flowing through to July 15th, 2020. Now, in this next slide coming up, I went ahead and just kind of outline what you're going to run into when you review this document. We're going to cover installment agreements, offers and compromise, non-filers, field collection, automated liens and levies, passport certification, private debt, audits, number 8. Number 9, EIC and wage verification. 10, IRS appeals, statute of limitations, and that last note under the practitioner priority service, where I'll repeat this a few times. As of this morning, that line has been down now for a couple of days. Verified that through a revenue officer. There is not an ETA right now for when that'll be up, where the assumption is they're trying to work and figure that out, how they're going to handle that remotely. But I'll repeat that a couple of different times. All right, let's start with existing installment agreements. Now, there's some wording in this form that we need to be aware of that's contradictory, and I wanted to point it out here in the first one. It starts out by saying payments are suspended in existing installment agreements between April 1st through July 15th. But let me quote this next part. If a taxpayer is unable to comply with the terms of an installment agreement payment, including direct deposit, the taxpayers may suspend the payments during this period if they prefer. So I think we're going to have to be aware of, there's going to have to be some updates coming on this one. What is actually completely suspended versus may suspended? Were they referencing the direct deposits where you're going to have to contact the IRS to do that? Typically, you have to be able to get in touch with the IRS for us through the practitioner hotline, which is down. They generally need 15 days notice to suspend a direct deposit from my experience of calling in there. So just be aware, this first section, there's some confusion there. I also want to hit on a couple of the questions that popped up already. Someone asked, if a taxpayer is currently on an installment agreement plan, will they be eligible to receive the $1,200 payment in what passed last night? So again, there's no details out at this point on that. That's not really applicable to what is in this document, nor is it discussed. And we hope there's going to be some outline and assistance on that as we go forward. This last note, the IRS will not default any installment agreements during this period, but interest will accrue. Next section, talk about new installment agreements. You continue to have the ability to enter into new agreements. My question as I read that section is, if someone was to do that and enter into a new installment agreement between April 1 and July 15, well, does that mean your first payment will be after July 15th? So let's say I do this May 1st, when typically you see that payment start in the next month period within 30 days. So again, just be aware of when you sign up for that agreement. It might be safer to aim to sign up for that in early July, so that first payment will kick into August. And I don't know anything in the weeds about this note number 2, but if there was an extension of this moratorium past July 15th, how would that affect some of these newly created installment agreements? So just be aware as you're talking to your clients, and if you decide to do this over this next 2.5 months, how that could be affected. Now we're going to jump into offer and compromise, the second section. So pending offers, you now have until July 15th to provide additional information that's been requested of the taxpayer. And the IRS will not be closing any pending OICs before July 15th. I'm going to make a note here before we go to the next slide. As we talk about audits and field collections with revenue officers, there is nothing in this document that says anything else has this July 15th extension for additional information. So I'm going to repeat that more than once. Please make the distinction. This is just for pending offers. But if you're working collection cases with a revenue officer or you're going through an audit, as you read through the information, it's clear to me they still expect to have information sent to them on the deadlines. And based on the conversation I had on a case this morning with a revenue officer, I have a deadline of next week to turn something in. So I just want to point that out.
So Vaughn, I was debating whether I was going to hop in here because I generally don't comment on legislation that has not yet become law. But I will tentatively answer the question from earlier, which was basically, would there be an offset against the stimulus package as passed by the Senate? So let me give that caveat because it has not been passed by the House yet. It is not law yet. But if it stands as passed by the Senate, there is not a provision for offsets in there. If someone is in an IA or in an installment agreement, then they are considered currently compliant. And so they would receive, assuming that they filed either 2018 or 19, it's going to be based on whichever one is more recent. So if they filed 19, it's going to be based on 2019. If they didn't file 2019 yet, it's going to be based on 2018. So again, caveat, that's not law yet, but that's the way that it currently looks.
And Knox, I agree with everything you just said. And just from your perspective, I'm hesitant to make too many commitments and comments on that, but that's how I read it as well. All right, on the next one, we're going to get into payments on your offer. So taxpayers have the option to suspend all payments on accepted offers. I've got to tell you, I'm very hesitant on this section. As many of you have gone through an offer process, it's quite difficult, regardless of what the commercials might say out there, to get an accepted offer. So be very careful about suspending payments on accepted offers, just my own opinion. The second note on here is, how does this apply? And I think we'll need clarification for submitted periodic payment offers, which is not mentioned in this document. Now, if you've done a lot of offers at a high level, the 12-month plan is where you would put down 20%. The 24-month plan is considered a periodic payment offer. Now, are they saying you don't have to send your monthly payment on these periodic payment offers while they're being considered? There is nothing in here about that. I would recommend you do not stop those until you can confirm that, and try to reach out to your offer specialist and get clarification. I suspect right now, if you call them today or tomorrow, they do not know that. To make that next payment and be reaching out to your offer specialist for clarification if you have one, because you may not be far enough along in the periodic payment process to have a person assigned yet. So be very careful about that. You can find your offer denied. Now, would you get appeal rights based on the situation and try to get it reinstated? That's very possible, but that's unknown at this point. Delinquent return filings as it approaches offer and compromise. So this is an interesting statement in here. And it says that IRS will not default any offers who's delinquent in filing their 18 return during the suspension period. Now, we're not talking about 19 yet. They do make a comment about that. They want you to file the 18 return and your 19 return on or before July 15th, 2020. I'm going to tell you, that caught my eye because I think there should be a clarification if it's for the 19 return. If you have a properly filed extension, you likely have until October the 15th. But the way that read in the statement mentioned 18 and 19 together. So just wanted to point that out. We'll be looking for some clarification on the IRS regarding offers and filing your 19 return by October 15th, not just July 15th. All right, new offers, not much to say here. There's no stated changes. You're allowed to submit an offer during the suspension window. I would just, one note on this is keep in mind that you're going to have to keep, even though the typical timeline for an offer to have someone review it could be 12 to 18 months, they're going to want to review whatever happened after this point. So if you have someone who's really suffering already in March and submit an offer for back taxes, fully expect for them to want to know what has happened since you submitted it in the 12 months. So if you did it now and we're coming up on April, I would, if I was an offer specialist, want to know what happened for the rest of 2020 and into early 2021 when they have a chance to review it based on the volume they're going to get. So just prep for that.
And Vaughn, I think we'll go ahead and launch our next polling question. So everyone get ready for that. This polling question: installment agreement payments can be suspended from April 1, 2020 to July 15, 2020. True or false? And we'll give you about a minute to answer that one.
Is there a lot of pressure here, Knox, that answering my question in the section I'm teaching that we get a higher percentage? I'm nervous already, Knox. I'm just saying.
So Jeffrey asked a question, will this be rebroadcast? He came in 20 minutes late. Jeffrey, to answer your question, the recording will be sent to everyone who is attending today. So you'll be able to answer that there. And so that is good news. All right.
I'm skimming through some of the questions as well while we're waiting for everybody.
Sure.
See if there's any that jumps out that in my world. I think I've answered. All right, so if a person already has been approved for an offer and payment is due by June 30, when is the payment now due? So based on the how this is written up, you would have until July 15th. But for those 2 weeks, I'm still encouraging you, if you can go ahead and make that payment timely. It doesn't mean that you won't be able to convince someone along the way if you took to July 15th on that, but that will take extra time. So if you need those extra 2 weeks, by all means, take it. Just be prepared just in case something falls through.
Cool. And we have a comment from Frank Donahue. He's a retired offer specialist, Vaughn. And he said that there are no appeal rights on OICs for lack of payment. However, if the monthly payment is missed and still required under the recent guidelines, then they will give time to make up the missed payments before voluntary withdrawal. And so that's the way that is typically handled.
Great pickup.
So,
thank you.
Yeah, thank you for chiming in there. All right, we're going to give 10 more seconds on the poll. And yeah, it looks like we've got most people who have responded, which is great. We'll close it in 5, 4, 3, 2, 1. And Vaughn, you want to tell them the correct answer?
The correct answer is yes, it can be suspended. So true. One note, I just saw one question, that a slide I had mentioned filing an extension by April 15th. Based on Knox's presentation earlier, as we wrote these last night and combined them, The way you read it is correct. You can file now by July 15th is how I understand that as well. So just that clarification for Wesley. Thanks for asking that, Wesley. All right, let's go into non-filers. This one's pretty straightforward. IRS says if you're a non-filer, get that return in. There we go, straight and forward, and let's move on. Okay, we're going to talk about revenue officers, and this is field collection activities. So since I'm using the word revenue officer, for many of you who may not do a lot of collection, I do want to make a distinction between revenue officers and revenue agents. So revenue officers are the ones in the field collecting non-filed returns or balance dues. Revenue agents are auditors out there, and we'll be covering revenue agents and audits in just a bit. All right, field revenue officers. Liens and levies, including seizures of a personal residence initiated by field revenue officers, will be suspended during this period. However, there's a note. If you're pursuing a high-income non-filer, they can proceed as warranted. So translation, if you've got clients and you're dealing with and I'll tell you, a high-income non-filer is not a current definition that I'm aware of. Here's what I did. I actually spoke to a revenue officer this morning, and neither one of us could come up with exactly what high-income dollar would be. I'm going to share a few things that we've run across in our practice. The revenue officer, in her mind, said $100,000 of income. I know ACS will often call it $125,000. Also, the Tax Reform Act of 1976, I looked this up last night, threw out an income figure of $200,000 or more. So, and then the next line on that slide before we go back one, Knox, is that ACS typically has a limit on collecting on individuals on tax liabilities of $250,000. But the document spoke to income. So I would go with what the revenue officer said to me this morning and consider that $100,000. But if you're dealing with a case right now with a revenue officer, please make sure you call them and e-fax them and confirm the status of your case in writing. Make the request. Don't assume that you can just take this. A revenue officer has that case for a reason, and I just don't want anybody out there to make that assumption. So jump on that, communicate with them. They have some latitude to work with you right now. You just need to be in contact, and they should be available. I've been able to reach out to the vast majority of the revenue officers on cases I'm working right now.
And just as a practice note, Vaughn, I think it's safe to say you should always make good communication with your ROs a priority. Would you agree?
I think you'll have some clients get levied if you don't do that. So at any time, whether it's during this process or out. So great point, Knox. And on that point, you're good on the slides, Knox. On communication, if you're having challenges of communicating with a revenue officer at any time, this is the key to having their e-fax. And make sure you're documenting those faxes, scanning those in, because you're going to want that package for any appeal. If they take action at any point, e-fax is your friend, and you've got that documentation. So just on that note. Now, number 5, let's make a distinction between field liens and levies and automated liens and levies. Now, any new automatic or systemic liens and levies will be suspended during this period. So you're dealing with the service center, ACS, that's where this is going, different from the field. So those will be suspended. And I have confirmed that in conversation with ACS as of Monday before the phones went down. Passport certifications, this will be suspended by the State Department and how this new process is worked during this period. Private debt collections of new delinquent accounts will be suspended. They will not be forwarding new delinquent accounts to the private debt collections during this period. I did see a question about pulling a case back from a private debt collection. You need to have that conversation with the priority hotline and ACS and see where they are in that process. So you can always call them and work it from that side. And that's just as a quick note on that. But right now, with that phone line down, if you're trying to do that right now, there is not a system to do that without having that conversation.
And just to clarify, even outside of this notice, you can always pull a file back from a private debt collector.
Mm-hmm. You're just going to have to, unless Knox, you know of another way other than contacting ACS. And I'm not aware of an online application right at the moment.
Technically, you can do it in writing by sending it to the private debt collector. I personally have never done it that way. I have always.
I'm not a big fan of in writing, so just because it may get lost and you're expecting it to come back. So If you do it in writing, please make sure you are calling into ACS and have it put in their notes that you submit it in writing. And at that point, you might as well call in and talk to ACS in the first place.
Unless, of course, they're not there.
And that's what we're dealing with. So the writing right now is a great place to start. Document that, and as soon as we can get into the system, you can call and verify that and put those notes in. All right, we're going to move on to audits. This is field, office, and correspondence audits, and this is revenue agents now. We talked about revenue officers in the field, but these are revenue agents. And the IRS will generally not start any new field, office, or correspondence exams during this period. However, they will start it if it's going to protect the government's interest regarding statute of limitations. So that could be the challenge you run into if you see this. Also, in-person meetings will be suspended. No surprise there, I'm sure, but they are allowed to continue the exam remotely. Now, this next section gets back to what offers allowed for giving extensions for returning documentation versus audits. Quote, taxpayers are encouraged to respond to any request for information they have already received. So I just don't want there to be confusion about what is allowed under pending offers to potentially override your thoughts in an ongoing audit or an ongoing field collection with a revenue officer. Now, it doesn't mean you can't reach out to your revenue agent or revenue officer and request that extension. I suspect they're going to work with you in many cases, but you need to communicate and put that in NEFACS and then follow up with a call. Also, taxpayers are allowed to request an exam to begin during this period if it's to their benefit. And there's a couple of details in the notice that talk about when that makes sense. So just be aware that you can request that if you like. Now, this is under the Earned Income Tax Credit and Wage Verification. Now, on this one, much like pending offers, taxpayers will have until July 15th to respond to the IRS to verify that they qualify for the EIC or they're verifying their income. Also, during this period of time, the IRS will not deny these credits because of failure to provide requested information.
All right, we're going to go ahead and launch another polling question. We are not supposed to be predictable for when we launch them, so here comes the next one. And this question, automated liens and levies suspended during April 1 to July 15. This same suspension applies to any and all liens and levies by field ROs. True or false? We'll give you about a minute to answer that.
Cynthia asked a question, will any of this collection suspension qualify for the trust fund recovery penalty? Cynthia, if you're working a case with a trust fund recovery penalty, I'm going to answer this two different ways. If you're working with a revenue officer now who's done an investigation or a revenue officer who's collecting on an individual who has trust fund assessed, I can fall back to what I said before. Please reach out to that revenue officer and communicate with them, because we're talking about liens and levies. Right now, a revenue officer could collect on any particular balance, whether it's a personal balance, a business balance on payroll tax, or trust fund. Now, if you're working with ACS in regard to someone who has trust fund penalties, once again, right now you can't communicate with them. But when they come back online, what we're talking about is they're still allowed to collect on that. They just cannot have a systemic lien or levy occur. So I think my consistent answer so far is make sure you're communicating, requesting extensions if you have deadlines. And I would also expect, other than if you're sending it to the service center, you really want to get back with that revenue officer and make sure they received that. I'm a big fan of IEFAX, and I call, and if they don't pick up, I leave a message letting them know that I got confirmation back on my side it was received, and I want to make sure they received that in case there was a problem on their end.
Somebody said they might be having trouble seeing the poll. If you are, click on the polls tab and you should be able to see it there. And we're going to go ahead and close this poll in 5, 4, 3, 2, 1. And Vaughn, it looks like we're at 61-39 on the split. So talk a little bit more about this one, obviously telling them the correct answer as you go.
Okay, the correct answer was false, because what we said was automated liens and levies are suspended. But we said, is it true or false that the same suspension applies to any and all liens or levies by an IRS field revenue officer? The reason I put this poll question in is if you're in a high income situation, those liens and levies are not suspended, and it's at the discretion of that revenue officer. Now, based on the conversation I had this morning, they do need approval, not just by their manager, but by the territory manager. However, they are still allowed to take action if they need to, if it's a high income or a high dollar liability situation is what I translate that to as well. So that answer to that question should have been false, just being aware of high dollar cases.
All right. And just as a test taking tip, anytime it says any and all, it's probably false.
Yeah, that was a setup question. Sorry out there. We're going to move on to point 10 under the IRS collection and Office of Appeals. Office of Appeals is still working their cases, no in-person meetings, but conferences can be held by phone or video conference. Now, it was interesting they included video conference. That makes complete sense. I just have not had a recent video conference in some time with anyone from the IRS. Plenty of phone conferences, but not video conference. So that should be interesting whether you need to host that or the IRS has their own system. So just a thought on that. Also, be aware that this part next about encouraging to reply to any outstanding request regarding appeals. Again, this is different from the pending OIC application that said pending OICs have until July 15th to prepare and share their information. If you're in appeals, you need to follow the deadlines been requested, or you need to contact your appeal officer and ask for an extension to be granted that extension.
And Vaughn, just to go back to the video conference, they do have their system, and they have been pilot testing that actually for the last probably 2 years.
Yeah, I just haven't had one.
Yeah, so.
Statute of limitations. The IRS will continue to protect all applicable statute of limitations. So that'll override anything we've talked about so far if you run into a situation that comes into play. And then my last slide, again, on the practitioner priority service, the IRS wants you to know please expect significant wait times if you're contacting the priority hotline for practitioners. Philadelphia is closed right now per the revenue officer I spoke this morning. And the system itself is down, and we're all waiting for some indication of when it'll be back up and at least be able to call back in. Knox, that wraps up the collection side. I'm going to kick it back to you for the next section.
All right, we're going to talk about the Families First Coronavirus Response Act. I know everyone is so excited about this. There are 2 tax-related bills that are contained within, and those are Division C and Division E, and then we're also going to talk a little bit about Division G. So these are the parts that have tax implications or significant tax implications. The first being the Emergency Family and Medical Leave Expansion Act. The second being the Emergency Paid Sick Leave Act. And then Division G is the part that's going to tell us how we pay for it. So I'm going to look at Division E first, which may seem a little backwards to you, but hopefully will make some sense as we move through why I chose to do it that way. So the Emergency Paid Sick Leave Act, in this case, paid sick time is provided to the employee if they're unable to work. But I need to emphasize this next little part that comes directly out of the bill, or telework. So like Vaughn and I were discussing this morning, he has employees that he has remoting in or that are working from home. If they're able to work from home, then they would not be eligible for this because they are actually able to work from home. So if you are unable to work or telework, then it could clue in. And there are 6 different ways. So we'll talk about the 6 different ways that this could clue in. The first is that the employee is subject to a quarantine or isolation order that is related to COVID-19. Now, that can be a federal order, that can be a state level order, or that can be a local order. Now, notice that this is a quarantine, and we'll talk a little bit more about that as we move through. The second is that an employee has been advised by a healthcare provider to self-quarantine. So in this case, this doesn't have to be an order from the government. This is that a healthcare provider has said you need to go self-quarantine. And we have seen this quite a bit. You need to go self-quarantine for 14 days, that sort of thing. Then that is going to qualify in this particular case. Or the employee is experiencing symptoms of COVID-19 and is seeking a medical diagnosis. So, we're going out, we're taking a test, but we don't have the results back. Then this is going to be a category where they could trigger it as well. The fourth item is an employee that is caring for an individual who is subject to an order described in 1 or 2 that we just talked about. So just to review what those are, one is the employee that is subject to that federal, state, or local order to quarantine. Or secondly, the healthcare provider has said you need to self-quarantine. So if you are caring for an individual who is subject to one of those orders, then that can trigger it. Or, and this one is where more people will be able to trigger this than any other provision, you're caring for a son or daughter of such an employee if the school or the place of care of the son or daughter has been closed, or the child care provider of such son or daughter is unavailable due to these precautions. So, for example, I live in Virginia. Vaughn lives in Virginia. Our governor has actually ordered that schools remain closed through the remainder of the school year. They're not going back to school this year. So schools are closed. So there could be lots of persons who would be eligible in the state of Virginia, but only if caring for that son or daughter prevents them from being able to work. And remember, what do we mean by prevent them from being able to work? That's not only in person, but that's also telework, which means they're not able to work from their home. So, for example, my daughter is out of school. However, I would not qualify for this because I am able to remotely work. And so because I am able to remotely work and I can still do my job, albeit it's a little more difficult, I do not qualify under this provision. However, I also have a wife, right? It can be argued that although one of us can work, one of us is pretty much homeschooling, and that's fairly true. Now, in her case, neither of us would claim it because she is basically homeschooling during the day, working some at night, and we sort of work together on that. So we are able to still do our jobs. Thankfully, our jobs are flexible time-wise, but not everyone has that scenario. So this is the one that's going to catch the most people in terms of being able to be valid. But you need to understand it's not going to catch everybody. Because if you are still able to remotely work, then you're not going to qualify for this. Only if you are neither able to work normally or telework do you able to pick up on this. And then the sixth one is the employee experiencing any other substantially similar condition as specified by the Secretary of Health and Human Services in consultation with both the Secretary of Treasury and the Secretary of Labor. That's going to be a pretty high threshold to cross because they have to all three agree that it's going to qualify there. So I don't think we're going to see many under that. Where I think we're going to see the most people, again, is on that caring for a son or daughter of such employee. And we're going to focus on that one a good bit because that's also the exact same definition that we're going to pick up when we look at the next part, or Division C, that we'll be looking at in a little bit. A couple of things we need to be aware of. There are accepted persons in
this. Can I jump in on that one real quick?
Sure,
please?
Go ahead.
If you can go back to that previous slide. So I've had a conversation with some small business owners, and that they've read through this specific slide, and credit to Knox on the telework, because most articles you may be reading are saying unable to work, but they don't mention telework. So if you've been proactive as a small business and your team is able to work remotely, you've actually removed the ability to take advantage of this paid sick leave because your team is able to work remotely, even if you are a business to business as far as receiving payments and your clients have stopped paying you. That's a different approach. I think we're going to be looking at the CARES Act, what's going through the Senate and the House right now for relief there. So just wanted to reemphasize this. If you're teleworking, this doesn't apply. And Knox, you did a great job with that. I just wanted to reemphasize that.
So the accepted persons are basically those that are in the healthcare profession as well as emergency responders. So If you work for a healthcare provider or you work for an emergency responder, you're basically, they can exempt you and you do not qualify for this. Why? Because we want our healthcare workers to work even if they're sick. We're afraid we're not going to have enough of them as this thing gets worse. That was kind of the thinking in Congress's head as they did that. So let's talk about the duration of paid sick time under this act. This is the smaller duration of the two that we're going to talk about. But this one includes 6 different things, where the next one, Division C, only includes 1. So for full-time employees, this is up to 80 hours that we're going to deal with, or basically 2 weeks. For part-time employees, the calculation is a little more complex, but we're going to take the number of hours equal to the number of hours that they work on average over a 2-week period. So that's what we're going to look at. And if that is not consistent, then we're going to average that over a 6-month period. And we're going to do what we call basically a look back in that case. However, there are cases in which the employee may not have worked the previous 6 months. So in this case, we have to do, and this is a direct quote, a reasonable expectation of the employee at the time of hiring. Now that verbiage is quite interesting, and we're going to talk more about that in a minute, because I think there are some real implications and insights into Congress's intention for this act in the words that we see right there. Reasonable expectation of the employee at the time of hiring. Keep that in your mind, because we're going to be coming back to that in just a moment. But before we do that, we're going to go ahead and launch our next polling question. And this polling question relates to Notice 2020-18, and you need to select the best answer. What is the best answer for this polling question? It supersedes Notice 2020-17. It defines affected taxpayer as anyone who has tested positive. It defines affected taxpayer as anyone who has symptoms. It defines affected taxpayer as anyone who is employed. We'll give you just a moment to answer that one. All right, couple of questions that I'm going to go ahead and quickly tackle, or at least say that I'll tackle later. Several people are asking, so how does this get paid for? We're going to talk about that. Don't worry, it's coming up. A couple of people are asking, is an elderly parent qualifying, or does it have to be a child? So an elderly parent can qualify, actually. But not obviously for the school provision. So it depends on which one. But for the paid sick leave, then yes, an elderly parent could, in that case, qualify, particularly if they're a dependent. All right, we're going to go back to a couple of other questions here. But before we do that, it looks like, let me go to the poll and see how we're doing. We are lacking 100 people or so. So I'll give you about 10 seconds. So go ahead and answer this poll in 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. All right, 75% of you got this one correct. The correct answer is that it superseded Notice 2020-18. An affected taxpayer is defined in Notice 2020-18 as anyone who has a federal income tax payment or a federal income tax filing responsibility. Remember, on April 15 of 2020. So that is how an affected taxpayer is defined under Notice 2020-18. It does not have anything to do with whether or not they tested positive. It does not have anything to do with whether or not they have symptoms. And it actually doesn't have anything to do with whether or not they're employed. It has to do with whether or not they have either an income tax payment or a filing responsibility on April 15 of 2020. So the best answer was superseded Notice 2020-17. So Good job. Looks like 3/4 of you got that one correct. We're going to go ahead and move along. By the way, Vaughn, someone's saying, watch the hands to the face.
I'm reading as I do it. You can tell what I do when I'm reading.
All right. So we're going to move along here and get into this act a little bit more. One of the interesting things about this is that you cannot require as an employer the employee to apply their other paid leave first. So whether that's paid time off, sick days, whatever other paid leave, you cannot require that that is applied first. This is sort of day one activity. And so you cannot make them run out their other leave. That makes it different than some of the other things that we have seen before and some of the other things we're going to look at in a minute. But for the Emergency Paid Sick Leave Act, you cannot require these other things to be happening first. So it is available day one. We'll talk more about that. The leave is also available regardless of the amount of time that the person has been employed. Now, I do expect the regulations to spell this out once we see those, but it seems certain that it is available from the first day worked. However, applicants are excluded. That much is certain to me in the reading of the bill. But what about if they're hired and not yet started? I personally think, now the regs are going to have to work this out, but I think the intent is to include this category. And part of why I think that's the intent goes back to something I highlighted earlier, and that is where it says reasonable expectation when they were hired. I think that gives us a clue into the mind of Congress or into the mind of the drafters of this legislation that they are intending for this to include persons who have hired and not yet begun work, which blows my mind. Now, we're going to need regs to tell us that for sure, but I think there's a decent chance that the regs are going to tell us, because I think it was probably congressional intent, that even if they are hired but not yet started, they could well be eligible for this act. And it is certain that they are eligible even on day one. So even if they came to work for 30 minutes and then left, they are eligible for this if they meet all of the other provisions. However, applicants are excluded. So if they have not yet been hired, then they are definitely excluded. Now, I'm not going to get into labor law, but I do want you to be aware that there are some teeth here. So you need to be really careful about terminations. And that's all I'm going to say about that. I'm not a labor law attorney in any way, shape, or form. But what about employees that work under a multi-employer bargaining agreement? Well, they're included. I actually had someone who texted me yesterday, Vaughn, asking a question. Well, what about people that work for a temp agency? Or what about people that work for a PEO, like an Insperity or a professional employer organization, that sort of thing? Well, yes, they are included. And the employer may make contributions to this multi-employer fund, plan, or program, but the employees are going to be paid for this out of the multi-employer fund. So, for example, and I'll just call out Insperity. They're one of the major PEOs in the country right now. If you have a relationship where you're sort of co-employed or dual employed with Insperity and where you actually work, then it would be Insperity who issues your W-2s, Insperity's who issues your paychecks. That's the PEO. You're still going to be eligible for this, and you're going to be paid by them. However, they are probably going to reach out to the employer and want contributions into that multi-employer fund. Going to be interesting to read the regs, I think, on this particular provision, but be aware that that is in there. The effective date. There's been a little bit of confusion about the effective date here. And what the bill actually says is 15 days after enactment. And so the effective date here is going to be April the 2nd of 2020. A little bit of confusion around that, but the effective date for this is going to be April the 2nd of 2020. Let's talk about employers for a minute. So the private entity or the individual that employs fewer than 500 employees is going to be subject to this, but so is a public agency or, and don't you love this catch-all, any other entity that employs one or more employees. So if you're between 1 and 500, then you're going to be subject. And on this particular one, it even includes some government. And so that is a little bit interesting for sure. So we're going to talk about how much is paid. And when we talk about how much is paid, it depends which paragraph we're talking about. So paragraphs 1, 2, and 3 primarily deal with things that impact me as the employee. Paragraphs 4, 5, and 6 primarily impact other people that I'm caring for. That's kind of the easiest way to think about it. So that's a loose way. Paragraph 1, 2, and 3 impact me as the employee. Paragraph 4, 5, and 6 impact persons for which I am caring. So if it is under paragraphs 1, 2, or 3, then it's going to be up to $511 per day, which again, we're looking at a 10-day period. So that would be $51.10 in the aggregate per employee as sort of the upper limit there, right? But if it's paragraph 4, 5, or 6, then it's going to be $200 per day, or again, 200 times 10, $2,000 in the aggregate. Now, we're going to talk a little bit more about this because it's actually 2/3 of their regular pay, but that cannot fall below minimum wage. So if we have employees that are close to minimum wage, it cannot fall below that, but typically it's going to be 2/3 of their regular pay up to either the 511 or up to the 200, and you see the aggregate amounts there. So again, employers are going to be private entities or individuals that employ fewer than 500 employees, but there are exemptions from this as well. Healthcare providers and emergency responders, that should sound familiar. We've talked about that, but there's another one here, and we're going to need some regs on this, but I'll tell you what I think is going to happen. Small businesses with fewer than 50 employees, but there's a big if. Notice I capitalized it here. If the imposition of these requirements would jeopardize the viability of the business as a going concern. It is my opinion. Now, you need to understand, I just said my opinion, right? We're going to need regs to come out to clarify this. But it is my opinion that it is the intent of Congress to include most businesses in this. How would it jeopardize the viability? Well, it's a cash flow issue, right? So if they are unable to, they have to front the money. And if they're unable to do that, if it would put them out of business and they can prove that, then they could get an exemption. However, there are provisions where they are going to be able to get advances or get very quick payback. Both of those are possibilities that I think we're going to see coming down in regs. And we've already had some hints that is coming in people I've been talking to at the IRS. So just be aware that I think this is going to be more, it's going to be less broadly defined than I think a lot of people are thinking. I think this is going to be very hard to reach because they're going to say, hey, we're going to get you very fast money and even possibly advances. But again, you're looking at opinion and you're looking at a bit of speculation here. We're going to need the regs to clarify that completely. And before we move on, we're going to go ahead and launch our next polling question. Again, I'm not supposed to be predictable on when we do these. And the question here, quarter 2 estimated tax payments for 2020. When are they due? June 15th, July 15th, August 15th, or September 15th? We'll give you a moment to answer that.
Knox, I'm going to take a couple of the questions that I've seen while we're doing that. Joseph asks, can you still request an audit report? Joseph, there shouldn't be any reason why you shouldn't. Revenue agents and revenue officers are available. Typically, they already have work from home situations anyway, so definitely go ahead and request that and see how that goes. Jacqueline asks, if someone's under an existing wage levy, will that be suspended? Jacqueline, there's nothing in the document to say that's what would happen. So you cannot assume that, but you might be able to make a case of undue hardship right now and request that that be released, depending on who put that in place. One other one from Wendy, of taxpayers' Social Security is currently being garnished by an IRS collection judgment. Will that be suspended temporarily? Wendy, there's nothing in here to say that's the case. Definitely contact the IRS under an undue hardship and request that as well. But that is something you'll have to proactively address and not expect that to automatically happen.
All right, let's look back at the poll real quick. And it looks like we are lacking about 100 people. So we'll give you 10 seconds. We'll close it in 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. And I am proud of you. Only 9% of you selected July 15. That would be the wrong answer. There were about 27 people who selected either August or September. That's the way wrong answer. But the correct answer is June 15th. And 88% of you got that correct. So good job. Looks like we had just over 1,000 responses on that one. So we're still having some people not answering the polls. Be aware you do need to answer at least eight of the polls in order to get credit for today. So don't mess up on that. There's still a few to come, but do be aware of that. Did have a question that said, how are we supposed to figure out what paragraphs 1, 2, and 3 are versus 4, 5, and 6? So let me go back and look at that real quick. And maybe I didn't make that clear. And so I apologize if I did not. That was way back here. On the very beginning. So here on this slide, these first 3 that we saw here that relate to the employee themselves, that's paragraphs 1, 2, and 3. The next 3 that relate to caring for others, that's paragraphs 4, 5, and 6. So I hope that kind of helps to clarify that. But that's the simplest way, at least for me, to think about it. Is that when we are dealing with things that impact me as the employee, then that's paragraphs 1, 2, and 3. When we are dealing with things that impact, I went to the wrong slide. But when we are dealing with things that impact someone else that I'm caring for, then that is going to be 4, 5, and 6. So that's kind of what it is. 1, 2, and 3 impact me. 4, 5, and 6 when I am taking care of someone else. All right. So labor law issues, as I mentioned, are going to be beyond our scope. But I do want to mention that in general, jobs are protected. And so you need to consult a labor law attorney before you get rid of people. I just want to throw that out there. I am not a labor law attorney. It's beyond our scope. I'm not even going to overly go there other than tell you consult an attorney. But I will mention that employers do have a responsibility to notify employees of the availability of these benefits. That is a requirement. And so you need to be aware of that as well. So let's talk a little bit. I went way, where did I go? I went into the wrong place. Sorry about that. I hate it when I skip around. All right. I'm going to have to go find myself. I apologize. All right. So what about employees that work under a multi-employer bargaining agreement? We talked about that. The enactment is there. We talked about this one. And yep, that's where we were. So we paid up to that amount, the 2/3, and we were talking about the fewer than 50 employees. So let's just sort of recap a little bit the relationship to paid leave. This involves for the emergency family and medical leave. That's what we're switching into here. As we're dealing with that, this involves the first 10 days not being covered. So again, the paid sick leave, it is covered, but under this act, it is not covered. So you need to be aware of that. Now, these two can dovetail together, and we're going to talk about that. There's been some confusion, I think, about that out there as well. But these two can dovetail together. So the first 10 days are not covered by this provision, which means that they may be unpaid, but you can also use any other type of leave, including the leave that is from Division E. So we're in Division C now, but you could use the leave that is from Division E or the paid sick leave to cover those first 10 days if you qualify, which means that in total, you've got potentially up to 12 weeks if you combine the two. Now, again, it doesn't have to work that way. It can be unpaid. They can also use PTO. They can use their regular sick leave. They can use whatever else. But the first 10 days are not going to be paid under this provision. So that's very different than the paid sick leave. So let's talk about the calculations. Well, it's an amount that is not less than 2/3 of an employee's regular rate of pay. So it's an amount that is not less than 2/3 of an employee's regular rate of pay. That should sound familiar. Very similar calculation, right? And in this case, it's not going to exceed $200 per day and $10,000 in the aggregate per employee. Now, I have to tell you that as an employer, that sounds like a pretty scary number, $10,000, right? Especially if persons can qualify simply by their child being out of school and they have to take care of them and can't come to work. And I'm in a state like Virginia where schools are closed for the rest of the school year. That's going to definitely cross the 12-week mark, right? So back to the point we talked about earlier, and Vaughn highlighted, I would be thinking about how can my employees work remotely if at all possible? Because if they can telework, then they're not going to qualify here. So again, very similar ways that this is worded from one act to the next. There's a lot of similarity. And again, we have the same calculations for part-time, meaning we've got the 6-month look back and the reasonable expectation here as well. So again, this involves up to 12 weeks of leave with the first 2 weeks not being paid. I think there's been some confusion here. There's been lots of people that say this is 10 weeks. Sort of. It's 10 weeks that's paid, but it's actually 12 weeks, the first 2 weeks of which, or the first 10 days of which, are not paid. So you need to be aware of that the first 2 weeks aren't paid, but it extends out 12 weeks. And so that's the way that the bill reads, and that's the way that I think is most helpful to think about it. Again, the labor law issues are beyond our scope. As we discussed a moment ago, you do have a responsibility to notify employees. Now, we're supposed to be getting new posters that we're going to put up. Department of Labor is responsible for that. However, if your employees aren't there, they're not going to see them. So you still have to notify them, which means you're going to have to think about, how does that happen? Is it by letters? Is it by email? Is it by calling them? Again, we may see some regs that come down from DOL that tell us more about how that has to happen. So how is this particular act triggered? Now, this is the Division C. This is the Emergency Family and Medical Leave Expansion Act. It is almost the exact same trigger as we talked about before when we're talking about school for a child. So an employee is unable to work or telework due to a need for leave for care of the son or daughter who is under 18 years of age if the school or place of care has been closed or the child care provider of such son or daughter is unavailable due to a public health emergency. So let's talk a little bit about some definitions. First of all, what is a public health emergency? This means that an emergency with respect to COVID-19 has been declared by a federal, state, or local authority. And by the way, it has now. So that has pretty much been met in most cases. And let's talk about what school is. This is not secondary education. This is not college. Remember, these are persons under 18 years of age. This is elementary school or secondary school in this particular case. Now, there's also a child care provider provision, but in this case, it's elementary school or secondary school that we need to be aware of. Again, on this date, it's not later than 15 days after the date of enactment, so it's going to be April 2, if not before. Why would it be before if the secretary comes out and issues something that says it's before? I don't actually anticipate that happening. I think it's going to be April 2nd, but it could happen. And once again, multi-employer bargaining agreements are going to be included as well. So now let's talk about how these things get paid for, which is Division G. But we're going to go ahead and launch our next polling question. And then we're going to pick up on a couple of questions while I do that, because I know that there has to be some polling questions here, or some questions that people have. So this polling question: the Emergency Family and Medical Leave Expansion Act and the Emergency Paid Sick Leave Act have an effective date of April 2. True or false? We'll give you a moment to answer that. Let me grab a drink. And Vaughn, if you would look and see what questions there are and throw them at me. You're muted, by the way, Vaughn.
All right. I was trying to be good and I muted myself again. Here we go. What about partners that are not on payroll? So taking draws.
Good question. So question here would be, like guaranteed payments. How does that impact? And the short answer is there is nothing in the bill that says that they are going to be fine, meaning there's nothing in the bill that says that they are going to receive payments. Now, we could see regs that specify something, but there's nothing in the bill that says that they are. To answer another question that I'm sure somebody has, what about self-employment? We're going to talk about that in a minute, because self-employment can qualify. And so there could be an argument that since the bill does specifically include self-employment, then it's possible that those general partners who, of course, are issued a K-1 might also be able to qualify under those same provisions. But again, we're going to need regs to spell that out, because the bill itself does not specifically say that those with guaranteed payments are going to be included in this. So again, we need regs on that, but I think there's a chance that the regs could include those situations.
One more for you. I'm going to skip over some of the additional collection questions because I'll come back to those I know we're getting near the end. If your employee has a 16-year-old at home, has an IEP related to special education, and you do not allow telework, would they qualify for the sick leave?
So if you do not allow telework and the employee has a 16-year-old at home and the schools have been closed by federal, state, or local authorities, then the answer to that would be yes. They would qualify actually for both of these provisions. So they're going to qualify potentially for the 12 weeks if the schools are closed that long. If you don't allow telework from home, then yes. And so that means that as the employer, you could be on the hook for up to 2/3 up to the ceiling in both cases. So, and that's going to be the $200 ceiling on that, because remember, that's caring for somebody else. So you're going to be $200 a day or 2/3, whichever is less in that scenario. So that's going to be kind of where you are. So yes, short answer, they would qualify. We're going to give about 15 more seconds on the poll. You can ask me one more question.
All right. Does healthcare provider include mental health provider?
Great question. We need regs to spell that out. Is the short answer. And my guess would be that may depend some on where they're working. Mental health provider that works in a hospital would certainly be included. A mental health provider that works, in a private practice may not be included. But again, we're going to need regs to spell that out. It's conjecture at this point. All right, we're going to close the poll in 5, 4, 3, 2, 1. And true is the correct answer on that. Both provisions will start on April the 2nd, if not before. So now we're going to begin to look at Division G, which is the tax credits for paid sick and paid family and medical leave. And the way that these happen primarily is payroll credits. I say primarily because it's not the only way it can happen. And we're going to talk some about that. I think payroll credits is what has gotten all of the press and all of the attention, even in some of the Facebook groups. But there are some other ways. So we're going to talk some through this. There are a couple of different payroll credits. First of all, there's a payroll credit for required paid sick leave, right? And that's that Division E. And then there's a payroll credit for required paid family leave, which is that Division C. So two different payroll credits that are there, and they apply to wages that are paid from the effective date, which again is going to be April 2nd through the end of the year. And so all of this expires 12/31 of 2020, and we need to be aware of that. So what's included? Well, it's the 100% of qualified wages paid, which is really cool. But even better, it also includes a pro rata share of the employer's qualified health plan expenses. Now we're going to see some guidance that tells us exactly that calculation. I think we can take some good educated guesses, but we're going to see some guidance on that will tell us exactly how we calculate that pro rata share of the employee's qualified health plan expenses. But this is important. It is refundable if it exceeds the payroll tax liability. So it is refundable if it exceeds the payroll tax liability. So what that means is that even if all or nearly all of your employees are qualifying, then you almost certainly are going to exceed your payroll tax liability, right? Because you're able to get back not only the 100% of wages, but you're also able to get back qualified health plan expenses. But even beyond that, typically what you pay on your payroll tax liability is simply all of your Social Security, Medicare tax, or your FICA, right? So that's basically what you're paying on your payroll tax. So it is not hard, if you have a decent percentage of your employees who qualify for this, to think that this could well exceed your payroll tax liability. So it's going to be refundable. And the IRS has indicated that these are going to be paid quickly. And so in these scenarios, what you want to do is make sure that you are paying these liabilities electronically, think EFTPS or something similar, so that you are paying these electronically, and then you can receive a direct deposit back to your account. The IRS has said these will be paid quickly. Now, how is quickly defined? We'll find out. But that is what they are telling us at the moment. So let's talk about those self-employed individuals. And we alluded to it a minute ago, but I know that a lot of people have this question. Well, self-employed individuals do not file 941s, right? They don't file 940s either, for that matter. So these are not persons that are paying in or that have payroll tax liabilities because they're self-employed. So what do we do in these cases? Well, the answer is that it's going to credit against their self-employment tax. So that means it's actually going to happen on the 1040, right? So it's going to credit against their self-employment tax. And we have basically the same calculations, except in this case, our look back goes over the entire taxable year. So we don't have that 6-month look back. What we're actually going to do is take the net earnings by self-employment. We're going to divide that by 260, and then we're going to multiply that by the applicable number of days. So for example, let's say that I'm out for 10 days, right? Then I'm going to take my total net earnings from self-employment. I'm going to divide that by 260, and I'm going to multiply that by 10. And that's basically the calculation there. And that is going to be a credit against my self-employment tax. Once again, this is refundable. But in this scenario, this is not something where it's going to be paid quickly back now. This is something that's not going to be reconciled until we have the 1040 that's filed for 2020. So be aware of that. For self-employed persons, this is not going to be as quick to get back. It's going to be reconciled on the 1040 against their self-employment tax. There's another interesting thing here, and that is that you have to provide documentation. Guess what? It doesn't tell us what documentation. It tells us that we're going to get guidance on that. And so we're going to need that guidance to tell us what we have to provide here, right? At the moment, it's pure conjecture on my part. I could do that. I'm not going to. I'm hoping that we're going to see that guidance pretty quickly, but we're going to have documentation for self-employed persons. Excuse me for just a moment. The other thing is that you cannot double dip with wages to exceed the max, but you can get up to the max. So if I have wages as a part-timer, for example, that don't get me to the maximum amount, and I'll also have self-employment, I can combine that, but I cannot exceed the maximum amount. With that, I know we've got to have some questions here, so I'm going to go ahead and launch another poll, which will give us an opportunity to answer a couple of questions here. And this question, healthcare providers and emergency responder employees are always eligible for the Emergency Paid Sick Leave Act benefits and the Emergency Paid Sick Leave Act benefits. Is that, I put the same. I meant to say both of the different ones. So I meant to say the Family Leave Act. My fault, I didn't word it right, but the answer is going to be the same as a hint.
While we do that, I'm going to take a couple of questions on the collection side, and
go for it.
You've been rolling along for a while. I'll give you a chance to grab something to drink. So Ashley asks, and Ashley, this is going to be a little more in-depth question, so I'll do it lightly, and we'll try to do something else more. Typically, we're required to provide 3 to 6 months of bank statements, etc., along with a 433A or 433B. But obviously, the income changes are newly being affected, and my ROs aren't accepting this as an excuse. How do we argue income changes due to COVID-19? Ashley, I wish that was a quick question. I'll tell you what I would do is if the revenue officer is not accepting this, I would still make the request in writing, ask them to deny it, and then at that point, they can send it to the independent reviewer, and you're going to get appeal rights out of that and address it that way. I found majority of my revenue officers are working with me very easily on this, but there's definitely going to be some out there who take a different tack. So I would definitely challenge that, propose it in writing, have them deny it, ask them to deny it in writing, and you'll get appeal rights that way. So that's the way I would approach that. Another one is if a taxpayer is on an installment agreement auto withdrawal program from their bank, how do they suspend that payment draft from their bank in order to avoid insufficient fund fees? I'm not sure how we're going to address the insufficient fund fees. I would say still, the process would be to contact the tax practitioner priority service, PPS, and put in, it takes about 15 days. We've done it before. If you can't get to them, at least submit that in writing so you can show that. At that point, whether the insufficient fund fees occurs or not, that is something you can fight after the effect has all gone through and address that if you want that removed. Knox, did you see a couple you wanted to take and while I was taking that, or?
I just want to mention there was at least one person said that they lost the video. If you have a problem with the feed, simply refresh your browser. It'll put you back in and you should be good to go. And I actually I've been answering some private chats to me, so I haven't looked too much. But I am going to press on because we don't have a lot longer. So Vaughn, if you want to look through some other questions, you can give those to me in a minute, but I want to press through this next section.
You got it.
Oh, I didn't close the poll, did I? I need to do that. Sorry. All right, we're going to close this poll in 5, 4, 3, 2, 1, and false is the correct answer. False is the correct answer on that one. Healthcare workers are exempted, as well as emergency responders. All right, we're going to briefly talk about Section 139 of the Internal Revenue Code. I'm not going to spend a lot of time on this. If you want to know more about this particular strategy, John Sheely and Tax Practice Pro actually are offering a full webinar just on this, and I would encourage you to take that if you're more interested, because I have about 2 minutes here, so I'm not going to give it the justice that they will be able to. But this involves disaster relief payments. And so this section actually came to be after 9/11, by the way. But it says that if you have a federally declared disaster area as defined by Section 165, which is basically the Stafford Act, then for the purposes of this section, qualified disaster relief payment means any amount paid to or for the benefit of an individual to reimburse or pay reasonable and necessary personal, family, living, or funeral expenses that are incurred as a result of a qualified disaster. And the really cool thing here is that you can exclude from net earnings for self-employment or wages these payments. So pretty cool provision. It's gotten a little bit of attention, but not a ton. And this is actually something that pre-existed this, but because the president did declare this as a disaster under the Stafford Act, then that opened up this possibility, this section of the code that we really haven't used to much extent, but actually came in after 9/11. So be aware of that. Little extra help that could qualify there, and there's some tax planning opportunities there. Again, if you want to know more about that, Tax Practice Pro and John Sheely are going to be doing a webinar on that specifically. I do want to mention the CARES Act. It was passed, 11:30 p.m. Eastern probably last night, but it has not yet passed the House. There is a chance that it will pass the House without being adjusted, without being changed. There's also a chance that it will not, and that the House will want some things changed. So I'm not going to comment or teach on this overly, but what we will do is go ahead and announce today that we're going to do a webinar next Thursday at 2:00 on the CARES Act. It'll be a 1-hour webinar, and we will make that one free as well. If you attended today, then you will get an invitation to that. So we're going to focus next week at 2:00 on the CARES Act. That is the stimulus bill, essentially. That we anticipate passing the House probably tomorrow and being signed before the end of the weekend. But again, we don't know for sure. So I don't want to overly speculate on that. And we had enough to cover in today's webinar already. So because it hasn't yet passed, we decided to move that to next week. So, but we're going to offer it for free. So you'll have a 1-hour webinar next week that you can attend as well if you would like on the CARES Act. It'll be the same place, same time, different URL. You'll get an invitation for that probably tomorrow. So with that, we are going to issue our last polling question. Actually, I'm going to issue the last main one. And this question is, has this webinar been super helpful, moderately helpful, a good review, or a waste of your time? Please be honest and go ahead and answer those for us. And then we will plow through some Q&A. So Vaughn, if you want to start looking for some Q&A, we'll start plowing.
All right, we've seen a bunch of these questions. How does the Sick Leave Act impact unemployment claims?
So I'm going to back up a little bit on that. That's a great question. And I have to be careful because I don't want to get into labor law here. I am not a labor law attorney. So I need to say that first. And that part of these questions need to be asked of a labor law attorney. I am especially not in a public webinar going to go into labor law, so just be aware of that. I will say this at the outset. It becomes effective April the 2nd. And so, I would suggest that you talk to your labor law attorney or your attorney friend for a little more guidance there. But it becomes effective on April the 2nd. The other thing that I will tell you is you definitely want to talk to an attorney, because there are some real teeth if it was seen that you did those actions solely to get around this provision. Then there are some real penalties for that. So you really need to talk to a labor law attorney, and I don't want to give you advice that can get you into trouble. So that's my best advice, is to speak to an attorney on that. We're going to leave this poll open for about another 10 seconds, and I'll let you go ahead to the next question, Vaughn.
Well, and I just want to say that's going to answer, I think, a number of the questions someone asked about dental offices. And a lot of those questions come back that those people had to lost their hours prior to April the 2nd. So I think we're going to have that apply to a number of the questions out there and not address those specifically. How does the sick leave pay apply to greater than 2% S Corp employee shareholders? Do they qualify?
So the short answer is yes, assuming they're on payroll, which they should be, by the way.
I'm going to take taxpayer owes for a 17-18 audit that we are in appeals right now. IRS said they would take the refund for 2019 toward taxes due, and that was a month ago. I have not filed 2019, hoping the taxpayer might get the refund. Thoughts? I don't think you're going to find a whole lot of things finishing any quicker right now. So just be aware, in a situation like that that's ongoing, anytime you have a collection situation, and I think you're talking about an audit. So if that audit hasn't assessed a liability and then you file a refund, if there's no existing liability, there is a way for the IRS to put a code in to hold that refund, but you won't always know what that is. So filing that 19, if they're going to get a refund, you may want to at least try to do that. It usually takes some time for an audit for the liability to post. And if it's ongoing right now, not knowing the full situation on that, I would just keep that in mind.
So I did launch the next polling question. And so just be aware of that, and you can answer it. I gave you a chance to do a little makeup if you missed a polling question along the way. So, and with that, we'll go to the next question.
We covered we've got a number of dentist questions. I think we took care of that. Already laid off employees. So that's been a lot of our questions about people who've already been laid off and how would this apply. Would an employee who is 72 with medical issues be eligible for emergency paid sick leave if she chooses to stay home during the crisis, does not have a doctor's note?
So the answer to that is no. If she's choosing on her own to stay home, then the answer to that is no. There has to be a quarantine order or the suggestion to self-quarantine from a physician.
If the extended due date for a fiscal year Form 1120 is April 15th, 2020, does that mean they get to July? And our 5471 still due April 15th of 2020?
Two different questions.
Mm-hmm.
The 1120, the answer is yes. The 5471, the answer is not necessarily. Be careful on that, especially on those international things. My opinion is those are not extended.
Eric, we just had a gentleman named Eric let out that the Department of Labor stated the date is April the 1st, not April the 2nd. I know you and I had a conversation last night about that, so I wanted to throw that out there.
Yeah, that's correct. April the 1st is the last date, and so April the 2nd is the date that the benefits would start. So we're just wording it differently, but it's the same calculation.
What about deadlines related to Form 8300?
Yeah, that is not, short answer is I don't think that's extended.
What about fiduciary tax on a calendar year?
So
Okay.
Sorry about that, guys. Hey, guys, sorry about that. I think my internet blipped out. Can you hear me, Vaughn? Can y'all hear me now? Awesome. All right. Looks like we're here. Sorry about my internet messing up. The good news is that we actually are at the time or over the time. So we'll go ahead and end here for now. Just wanted to say thank y'all for being with us. Vaughn, do you want to go ahead and close us? All right. Not sure that Vaughn can hear me. So just wanted to say thank you very much for joining us this week. For those of you that are not familiar with the Virginia Society of Enrolled Agents, we will be rolling out several new webinars over the next little bit. And so we hope you've enjoyed today. We will have another free webinar for you next week on the CARES Act. That will be a 1-hour webinar. And then we'll also have some paid webinars that will be available coming up, particularly over the summer. And so stay tuned for all of that information. We will be sure to get that out to you. Otherwise, take care. God bless. And I hope you all have a wonderful day.
Thanks, Knox. Looks like I went down, so I'm back.
All right. Take care, everyone. We appreciate y'all.
Y'all take care. See you next week. Is it just you and me?